Hello again, Lance Browning, Income Solutions Wealth Management. Tyler, just a little housekeeping before we get on topic here. Those of you that have been praying for rain, please stop. We get it, okay? In our talk here today, we're going to talk about what the Federal Reserve actually is, what it wants, what it thinks, and some possible outcomes. This is a picture of the current Fed chair, Mr. Jerome Powell. He goes by Jay. So this picture of Jay Powell, and let's talk about something that's been on our minds a lot here lately within the last year or so, the Federal Reserve. We've talked and written extensively about our own opinion of the Federal Reserve. And as many of you may know, we do not hold the Fed in very high esteem here. You can probably tell that from our intro music that you just heard. We often refer to them in derogatory terms such as the Sanhedrin. So what is the Fed? William Miller, who's the former Fed chair in the 70s, he's going to be a little bit before Paul Volcker, said that 23% of the U.S. population thought the Federal Reserve was an Indian reservation. 26% thought it was a wildlife preserve, and 51% thought it was a brand of whiskey. So, there you go. Given its seemingly unlimited and unaccountable power, the Federal Reserve has been the subject of numerous conspiracy theories over the years. One is a series of books entitled The Creature from Jekyll Island. Here's a copy of that cover. The story goes that the Federal Reserve was created by a clandestine meeting of financiers, other Illuminati, and very powerful people. The line of thinking here is that the Federal Reserve was created in secret, basically out of thin air, for nefarious purposes. Here's a more official definition of the Fed. The Federal Reserve System, or FRS, is arguably the most powerful institution in the world, financial institution in the world, and I don't think there's any argument about it. Here's some key points. So the Federal Reserve System is the central bank and monetary authority of the United States. Most other nations have a central bank as well. The Fed provides the country with a safe, flexible, and stable monetary and financial system. Don't laugh at me. I'm just telling you what the slide says. The Federal Reserve System is composed of 12 federal regional banks that are each responsible for a specific geographic area of the United States. We have one in Dallas, for example. The Fed's main duties include conducting national monetary policy, supervising and regulating banks, maintaining financial stability, stop laughing, and providing banking services. The Federal Open Market Committee, or FOMC, is the Fed's monetary policy making body and manages the country's money supply. More on that in just a second. Now let's talk about what are widely known as to be the Fed's mandates. And there really are just two. So number one, the Fed is mandated to provide full employment. Given that unemployment in the U.S. is at historic lows, we're going to say they've done their job there. Number two is price stability. Here's where the struggle's been over the last couple of years as inflation has just exploded. We've talked extensively about this over the last couple of years, and especially in our halftime reports. Lastly is the poorly kept dirty little secret. This is not their job, but it's become their job. The Fed has to somehow, some way, figure out a way to fund our astronomical national debt. While this is incredibly unfair to them, the Fed has been forced to navigate the financial mismanagement from the political ruling class in Washington, D.C. Let's talk about what the Fed wants. To sum it up, really just two things. They want to lower asset prices, specifically for stocks, bonds, and real estate. So here's an article from Michael Leibowitz from back in January, and I read Michael a lot. He puts out some really good stuff. At the bottom of the slide, Michael makes the statement that, quote, it could be useful to be able to intervene directly in assets where the prices have a more direct link to spending decisions. Keep that in mind. He's referring here to what is known as the quote-unquote wealth effect. Basically, the wealth effect means that the higher people's investment account values are, the more confident they are about spending money and buying stuff. By causing lower asset prices, the Fed hopes that this will greatly reduce demand because people are less confident and therefore reduce inflation. The other thing that the Fed wants is higher unemployment. Okay, yes, I just said that. Remember that unemployment is extremely low right now. The Fed is worried about something called, again, quote unquote, the wage price spiral. In other words, we have been in an environment where there are more jobs than there are people to fill them. I mean, a lot more. To fill these jobs, employers are having to pay higher and higher wages. To compensate for these higher wages, these same companies are charging higher prices to their customers. Because prices for goods and services keep going up, workers are demanding higher wages. That's the spiral. Higher wages beget higher prices, and higher prices beget higher wages. This has been a big component of our recent inflation problems. Another thing on the Fed's wish list is tighter lending standards. While the Fed would never admit it, they have been the cause of many of the banking problems that we've seen so far this year. To reduce their own risks, the Fed is basically pushing banks to starting to become a lot more restrictive on who they'll loan money to. We're really starting to see this. The reason this is so important is because most consumption in this country is fueled by borrowing. People borrow money to buy stuff on credit. So, the harder it is for people to get loans, the less stuff they will be able to buy. Less credit means less demand. Less demand means less inflation. That's the theory. Keep in mind, there's a tremendous amount of consumer debt out there. I mean a bunch. And we're going to talk a lot more about this in our halftime report coming probably the end of next month. Lastly, the Fed is desperately trying to reduce the money supply. Immediately following the COVID pandemic, the Fed began aggressively printing money. They also dramatically increased their quantitative easing, or QE, program. QE, if you'll remember, is where the Fed prints money, borrows money by buying bonds, then prints more money. This, coupled with a massive amount of stimulus coming out of Washington D.C. post-COVID, flooded the U.S. economy with cash. This flood of cash, what we referred to in our halftime reports as too many dollars, along with a severely damaged supply chain from the global shutdown, what we've always called too few goods, was the perfect storm for the inflation that the Fed has been trying to fight. To fix the problem that they themselves pretty much caused, the Fed has begun draining liquidity from the economy. On the far right of this chart, you'll see a dramatic drop in money supply. By raising interest rates and reversing QE, the Fed hopes to get inflation back below their 2% target. Switching gears, let's talk about what the Fed thinks. It's an extraordinarily rare event when the Fed admits that their actions can cause problems. Here's a CNBC article from last November where former Boston Fed president says that we will have a recession this year, 2023. This echoes what other Fed heads have said so far this year. Fortunately or unfortunately, recessions tend to be very good inflation-fighting tools. So the Fed is thinking one thing, And the market is thinking something very different. I'm probably showing my age here a little bit, but do you remember the old Alfred E Newman pictures from the old Mad Magazine cartoons? And Alfred's tagline was, "What, me worry?" While the Fed is seemingly being very transparent in calling for recession, the market seems to believe everything will be okay. The market's rallied pretty well off of its lows from last October, despite a great deal of data telling us that the economy is clearly slowing very rapidly. One of my favorite market indicators, and this is often kind of what we call a contrarian indicator, is the CNN Fear and Greed Index. This speedometer looking graph tells us what the market's current mood is as it relates to risk taking. Last October, at those lows, we were way over to the far left into the extreme fear portion of this gauge. Well, 6 months later, here we are back at greed. The great philosopher Gordon Gekko was quoted as saying greed as good. And hopefully you'll get that movie reference from the movie Wall Street. Clearly, the market and Fed are on opposite ends of the spectrum as to what they think is going to happen with the economy. Usually, when the market and the Fed disagree this much, somebody ends up being wrong. Stay tuned. And let's talk about the dreaded R word, recession. So what is actually a recession? That has that connotation of being bad and negative, and it is. Let's find a good textbook definition from a Forbes magazine article this past Valentine's Day. So an economic recession happens when an economy's overall output shrinks rather than increases. Typically, this is measured by changes in gross domestic product, or GDP. As we've talked about a lot, GDP is the bottom line report card on the U.S. economy. GDP for the first quarter of 2023 was only a positive 1.1%. Now, while that is technically positive, that's still not very good. I would call that about a D plus on our last economic report card. Let's talk about the possibility of a so-called quote-unquote rolling recession. And this is a new one on me. This is from the same Forbes article and is being perpetuated by a lot of economists, including the very sharp Liz Ann Sonders of Charles Schwab, among others. So a rolling recession is a special type of recession that does not affect the entire economy equally or at one time. Instead, it hits different market sectors at varying times. This means while the economy as a whole might not be in a recession, people in certain areas or in particular industries could definitely feel like they're in a recession. Ms. Saunders believes that we could see a recession hitting the economy and the market slowly and gradually rather than the bottom falling out all at once. And the more I think about this idea, the more I think there might be some credence to this. She might very well end up being right. Let's talk about 3 plausible scenarios going forward when we talk about the economy and recessions. The first one is the first scenario, and this is from Investopedia. Investopedia, by the way, is a great resource for defining a lot of these financial terms that we use and that you hear in the media. So the market is hoping for something called a soft landing. A soft landing in economics is sort of a cyclical slowdown in economic growth, but that does avoid recession. A soft landing is the goal of a central bank when it seeks to raise interest rates just enough to stop an economy from overheating and experiencing high inflation without causing a severe downturn. It's basically a gradual, relatively painless slowdown. And so Lancapedia, as opposed to Investopedia, will also define financial terms. It just provides my snide remarks along with the definition. So, according to Lancapedia, a soft landing is a mythical place filled with lollipops and unicorns where the Fed actually gets it right. The market right now is all in on the hopes of a soft landing. A so-called hard landing can be defined by a marked economic slowdown or downturn following a period of rapid growth. The term hard landing, and you see the plane here on the road, the term hard landing comes from aviation, hence the plane on the highway. It refers to the kind of high-speed landing that, while not an actual crash, is a source of stress as well as potential damage and injury. Hard landings are often caused by monetary policy interventions meant to curb inflation. We're seeing that same type of monetary policy intervention from the Fed right now. Economies that experience a hard landing often slip into a stagnant period of growth or even recession. If you're an eternal optimist, you may subscribe to our last scenario. Yahoo News defines quote-unquote no landing here. As opposed to a soft landing or hard landing, a no landing scenario involves the economy continuing to grow despite the Federal Reserve's best efforts to tamp down inflation with interest rate hikes. I referred to this earlier maybe as the Alfred E Newman theory. I believe personally this is the least likely scenario given the Fed's past history with aggressive interest rate hikes. In conclusion, so the multi-trillion-dollar question is, can the Fed thread the needle? Can they pull this off without doing a great deal of damage to the economy and even more particularly to the markets? We're going to talk a lot more about this going forward, and we'll talk a lot more about this in our halftime report coming up. Hope you have a great rest of May and into June. We'll talk again in the next month. God bless. Take care.